Can everybody hear me? Okay, great. I just want to let everybody know that we're going to get started here in just a few minutes. It's a couple minutes till, but we like to give it a couple minutes after, give everybody a chance to get on.
Or hash sign.
Hello.
Hey there, we're going to get started here in just 1 or 2 more minutes. Yes, please mute your phone or your computer audio.
Happy Tuesday, everyone. Thank you for taking time out of your day to join us.
This is Michelle Clark with Rising Point Solutions. For those of you that don't know me, I'm the regional manager for Florida. The owner of Rising Point, Carl Stanley, will be presenting the webinar. It'll be really informative, and we would love for you all to type in questions as we go. Carl will get to all of them by the end of the webinar, which is scheduled for an hour, but we may go over just a little bit depending on how many questions we get. So without further ado, Carl, take it away.
Thank you, Michelle. I want to thank everybody for being on the phone today. I see quite a few names that I know and a few that I don't. I'm hoping that every one of you guys will find this really valuable. As Michelle said, it typically takes me an hour to get through this info, sometimes a couple minutes longer. So it may be 11:05, 11:10, but and then I want to make sure that we get every single person's questions answered. So any question you have, please feel free to type in the chat box. And if it's related to whatever I'm talking about, I might go ahead and answer it. If not, then I'll just get to all of them at the end. But the main goal of this webinar is for you guys to kind of understand more about what you're dealing with when you're dealing with consumer. Here we go. There's 3 credit bureaus, Equifax, Experian, TransUnion. The consumers have 2 big misconceptions about the credit bureaus. Either A, they think they're somehow affiliated with the government, which is kind of odd, but a lot of consumers do think that. They have kind of big official sounding names. They either have the word bureau or agency attached to it, which is kind of elicits, it makes you think of government or quasi-government. And the other big misconception amongst consumers is they're somehow consumer-driven organizations. They're called consumer credit bureaus, they're called consumer credit reporting agencies, but as a consumer, we're not a customer of the credit bureaus. That's not how they make all of their money. And if you've ever tried to call or get an answer to a question or fix an error on a credit report with a credit bureau, you know. So we know that about 79% of Americans have errors on their credit report. That's 4 out of 5 people. Most people don't know because they don't check their credit very often. One thing I want to talk to you guys about is optoutprescreen.com. See, the bureaus make all of their money by buying and reselling our personal information. All of us have our information bought and resold on a daily basis. And this causes lots of issues. It can cause issues with identity theft, exposure to data breaches, or just other errors happening on our credit reports. I'm always very careful to talk to my mortgage partners about, it's a good thing to have conversations with your borrowers about opting out. If you're a mortgage person, you're familiar with trigger leads. A borrower comes to you, they apply for a mortgage loan, and then in the next 2 weeks, they get 10 or 12 calls from other mortgage companies trying to undercut your rate or sell them something different than you are. So I always think it's a great idea to talk to your consumers about opting out, especially if you can talk to them about it early in the process. It's something great to send out on database or email newsletters or social media to encourage people to do that. That way, when they do come to you to apply for a mortgage loan, you're protecting the integrity of your lead and they're not sold off to a bunch of other people. And individually as yourselves, I would definitely opt out. If you have not opted out as an individual, I would definitely opt out. I've got the website on the screen here, optoutprescreen.com. You can go there. They're going to give you a 5-year and a permanent option. Always do the 5-year option first. It's online, it's easy, takes 5 minutes, and you'll be opted out within 5 to 10 business days. And that's what you want to instruct your consumers to do as well, because it's the shortcut. It's the fast way to do it. You can opt out for life, and if you do the life option, you have to sign a letter, print a letter, sign a letter, mail it to the address that's on the website, and it could take up to 30 days. So what we always tell people to do is do the online opt-out first, and then you can follow it up with a letter within the first month. Then that way you're opted out for the rest of your life. But I would both do it individually, and I would do it have those kind of conversations and encourage your consumers, your borrowers to do it as well. So credit monitoring is something that's done by the bureaus. So, and we're about to talk about credit scores, but there's nothing preventative about credit monitoring. Credit monitoring is not going to keep something bad from happening. It's only going to let you know when something bad does happen. And so I already mentioned that 79% of Americans have errors on their credit report, and most of them don't know because they never monitor their credit. And when they do monitor their credit, where are they going? Are they going to Credit Karma, other credit monitoring websites that are owned by the 3 credit bureaus? They go there and they get a misrepresentation of what their real credit scores are. You as loan officers know that it's very common that a consumer may go to Credit Karma and see a 710 credit score or 690 credit score, and you pull it and it's a 615 or 625. The reason for this is the bureaus and Credit Karma are pushing out consumer-based scores that have nothing to do with mortgage lending. We call them FACO scores rather than FICO scores, but this causes a tremendous amount of confusion with the consumer. And they don't understand why they're seeing one score versus what a mortgage score is. It's important for you guys to know that a consumer is 2 levels away from a mortgage score. They're 1 level away because they're pulling a Credit Karma or a credit monitoring consumer-based score that has nothing to do with lending. And the average difference between a Credit Karma score and a mortgage score is about 60 to 80 points. But they're also a 2nd level away from a mortgage score because even within FICO, a mortgage score is the strictest score. So it might be very common for you to hear a consumer say, hey, I just bought a car a couple of weeks ago and my score was a 650. And you pull it and it's a 605. And so there can be 30, 40, 50 points variation just within the FICO scoring models themselves. So they've got to get to a FICO scoring model, and even within FICO, they've got to get to a mortgage scoring model. Now, right here on this slide, you'll see that currently used by Fannie and Freddie, the versions of FICO scoring models that you guys are using is version 2, 4, and 5 across each of the 3 bureaus. The newest one of these scoring models is from 1999. So the mortgage industry is working on a 20-year-old 4th generation legacy scoring system. We have FICO 8, FICO 9 now. FICO 8 and FICO 9 have already been adopted by the credit card and the auto industry, but the mortgage industry is still using a system that's 20 years old. And the mortgage scoring formula is the strictest scoring formula. It's the most penal by far. Causes a lot of confusion amongst consumers. Now, I have a website listed at the bottom here. It's called myfico.com. All these credit monitoring sites that are pushing out these fake artificially inflated credit scores are owned by the 3 major credit bureaus. Just about every one of them. Credit Karma is owned by Experian, and most of them are owned by, Experian or the other bureaus. They're not real credit scores. They're fun scores or fake scores. Most of them have been developed by math clubs at universities. So for a consumer who wants to know their real scores, they can go to this website, myfico.com. See, FICO is the one that does credit scoring. FICO, the bureaus don't do credit scoring. They'll sell you fake credit scores, but they're not the ones that do credit scoring. Credit scoring is licensed through FICO. And 95% of lending decisions in the U.S. are based off FICO scores, and 100% of mortgage lending decisions are based off of FICO scores. Sometimes you may have a customer that doesn't want you to pull their credit, or maybe they were doing some work and trying to improve their credit. Maybe it's somebody that was in our program. A lot of times we'll send them to MyFICO because that's the only place you're going to get a true, accurate representation of your score. FICO says, hey, look, the credit bureaus are making $8 billion a year selling fake credit scores and credit monitoring services. How much money could we make if we sell real credit scores? We are the credit scoring people. So they developed the consumer access site 4 or 5 years ago. And when you go there, you can get your mortgage score, your auto score, your credit card score, your bank score, all versions of your score. If a consumer goes there and it says their mortgage score is a 697 and they apply for a mortgage, the next day it's going to be 697. It's point for point. So it's a little more expensive than, Credit Karma is free, but it doesn't give you all 3 bureaus and scores. And it's not a real score. And then the other credit monitoring sites, some of the score models are closer, and you get all 3 bureaus, but it's not an exact score. So this is the only place you can go and get your exact point-for-point score. So FICO 9, as I mentioned, is the newest version of FICO. It came out about 3 or 4 years ago. FICO 8 came out in 2008. And back in 2008, the mortgage industry was supposed to migrate over to FICO 8. And they never did, because what happened in 2008? We had the housing crisis and a bunch of bad things going on, credit crunch. And then FICO 9 came out about 3 years ago. And each successive version of FICO has been a little bit more lenient in credit scoring, yet more predictive in predicting default rate. So the credit card and auto industry has moved to the newer versions of FICO because they get what they want out of it, which is predictive analysis of risk. But at the same time, the consumer has benefited to having better scores because the scoring systems aren't as strict. So some of the changes in FICO 8 and FICO 9 versus the version that you guys are using, and remember this whole discussion, you guys, the mortgage industry, is still sitting on version 2, 4, and 5 from 20 years ago. So it's business as usual for the time being for you guys. Fannie and Freddie, are testing and looking at options in the background to migrate to a newer scoring model. But we're not sure when that's going to happen. It could take several years. And once it does, the decision is made to do it, it could take 2 or 3 years to implement. Now, when the mortgage industry moves to a new scoring model, FICO 9 or FICO 8 or even maybe even a newer version, but when they move to an updated, newer scoring model, the average credit score of all of your borrowers is going to go up about 30 or 40 points. Now, that's not going to be the A-plus borrowers, probably, because they're not being affected by these changes. But those people who have average credit, mildly damaged credit, bad credit, obviously they're going to see the most impact in the more lenient scoring system. So we already talked about the fact that 79% of Americans have errors on their credit report. And I'm not talking about bad credit. I'm not talking about, hey, a collection hit and I thought my insurance company was going to cover it, or I co-signed for my sister's cell phone and she didn't pay it, or I was on vacation and my mortgage payment didn't get on time. Those are not errors. Those are unfortunate mistakes, but not errors. When I talk about 4 out of 5 people having errors on the credit report, I'm talking about errors through no fault of their own. Errors that are being reported to the credit bureaus by creditors. And you got to understand that the bureaus don't have a real vested interest in protecting the integrity of the information in our credit reports. That's why it's up to us to look at our credit reports, monitor our credit reports, check for errors and things like that. But it's astonishing to me that the Fair Credit Reporting Act was enacted in 1970. We're in 2019. That's 49 years. 49 years after the Fair Credit Reporting Act, we still have 79% of Americans with errors on their credit report. That just tells you that it's not a big priority for them. They have armies of attorneys and lobbyists, and nobody really holds the bureaus accountable. Because as a consumer, we're not their customer. The customer is the banks and the mortgage companies and the credit card companies and anybody who wants to buy and sell information. So most errors are due to data entry mistakes. They're not malicious. But the Fair Credit Reporting Act is supposed to protect us from inaccurate, duplicate, unverifiable, malicious, obsolete information being reported on our credit reports. And it's not. But these data, when billions of records are exchanging hands daily, errors are going to happen. And again, they're usually truly mistakes. Somebody's typing too fast. They transpose the last 2 of a social security number. They hit a junior instead of a senior in a drop-down menu. They have 8 customers with the same name, and they apply the payment to, this Michelle Clark when it should have been applied to this Michelle Clark, and now you have a late payment on your credit. And the problem with the credit bureaus isn't that errors happen. They're going to happen. The problem with the credit bureaus is there's no efficient way for consumers to fix them once they do happen. I always tell a little story at this point about a woman in Washington, and there was a very interesting special on 60 Minutes a few years ago. It must be 6, 7 years ago by now. But you can YouTube it or Google it. I think it's called Credit Bureaus Revealed. And they outlined a story of a woman in Washington who had perfect credit all her life. And she went to apply, and I think it was for an adult child for a student loan. But she applied for something and she got turned down, which was a real gut punch because she had never been turned down for anything in her life. And so she was panicky, obviously, and this was before credit reports were as readily available to us as they are now. She went out, found a copy of her credit report. She saw that there was a charge-off or a bad debt from a local bank on her credit, a bank that she had never done business with. So she went down there and talked to somebody, and they said, you know what, you're right. Not you, our mistake. And they gave her documentation that this should not be on her credit report. They are the ones that furnished the information to the credit bureau, and they're the ones that gave her documentation that it shouldn't be there. With that proof and hard copy documentation, how long do you think it took to fix with the credit bureaus? I don't really expect any answers, but I'll tell you, it was 2 years. 2 years later, it was still on all three credit bureaus, not fixed on any. So she hires an attorney, and through the help of the attorney and demand letters, she's able to, and it was an attorney that specializes in working on credit issues or with credit bureaus. And he was able to get it off 2 of the 3 bureaus, but not one of them, which was Equifax, the data breach. And so they decided to sue Equifax, which few people do, sue and take on the big bad bureaus. But she sued Equifax, and she won an $18.6 million, judgment. And so the whole point behind that story is that there's a real cost to errors on credit report. It's costing people the ability to achieve the American dream, start a business, become a homeowner, co-sign for an adult child's student education, whatever the case is. And so that's the problem with errors on the credit report. A lot of states had really started going after the bureaus hard about 5 or 6 years ago, and the CFPB was getting involved as well. So the CFPB gets involved with the credit bureaus and says, hey, 79% of Americans have errors on their credit reports. And then the bureaus decided to do their own study, and then the bureau study said that only 2% of Americans had errors on the credit report. That was a bureau commission study. But a lot of states were up in arms about this, and a collective group of states decided to sue the credit bureaus. It was led by the state of New York. And, their contention was, hey, these errors in credit reporting are causing our citizens harm, and, we're going to sue on their behalf because of the mistakes and errors that the credit bureaus are making. And so out of this lawsuit came a big settlement, and the settlement basically brought us this, which is the National Consumer Assistance Plan. Now, it's not legislative, it's not law, but this is an agreed upon settlement between the bureaus and the states. And so far the bureaus have been sticking to it. But out of that settlement came the National Consumer Assistance Plan. I'm going to tell you guys about a few of the things that have become standard and the positive changes for consumers out of that. You can visit the NCAP website and learn all about it, but there's been a lot of changes in the last 2 years in regards to the credit bureaus and how they can report certain items on the credit report. The biggest noticeable change for you guys as mortgage lenders is going to be the fact that you don't see civil judgments and federal tax liens on credit reports anymore, right? I don't know if you guys remember 2 years ago in the summer of 2017 when the big buzz was, hey, by the end of July, they will no longer be able to report tax liens and civil judgments. Well, that didn't happen. It wasn't really implemented until May of 2018. But since May of 2018, you have not seen civil judgments and tax liens on credit reports. So civil judgments and tax liens no longer show on credit reports, nor do they affect the consumer's credit score, which is a big plus for the consumer, because if you have a tax lien or civil judgment, it's really affecting your score. And they also know, those consumers, that they can't really buy a house with a civil judgment or tax lien on their credit report. But now they don't see it on their report anymore. It's disappeared. Where did it go? It's not there anymore, and it's not affecting their score. So a lot of these people think, hey, I can go buy a house now because that's no longer there. And a lot of consumers are not disclosing to our mortgage partners that they have these items on their credit. Now, the mortgage industry has adapted. You guys have other reports that you pull, whether it's a CAVERS report or a public record search or a Loan Guard product. But I do want you to make you aware that a lot of consumers are not disclosing this, and they think they can get away with it because they don't understand you're going to run that supplementary report, or they don't know. So it's good to talk to them and tell them up front, hey, if you have these type of items, we're going to know whether it's on your credit report or not. Because I have seen it cause some problems in deals as they move along and it wasn't disclosed. But they're no longer on credit reports, and they're no longer affecting the score. So when they buy houses, or when they buy cars and credit cards and other furniture and other stuff, they're getting the benefit of not being penalized for those civil judgments or tax liens. Only when they apply for a mortgage is that stuff still going to become or would still be a problem. Some other changes or some other positives out of the National Consumer Assistance Plan is that there's an enhanced dispute process for ID theft and fraud. As you may know, you put a fraud alert on your credit when you suspect suspicious activity, or you suspect that, you know, maybe you lost some personal information, or maybe there's an account on your credit report that's not yours. So you may put a fraud alert on your credit. Previously, that was only 90 days. Now, when you put a fraud alert on your credit, it lasts for a full year. Okay. The next step up from fraud alert was credit freeze. And that's, you know, most mortgage partners I know don't like credit freezes. A lot of people would freeze their credit. It costs money to unfreeze. It was time consuming, not easy to freeze and unfreeze. And a lot of people forgot they froze it. So they would go apply for a mortgage, and then lo and behold, you couldn't pull their credit because it was frozen. They couldn't remember their PIN number or find their PIN number. So now they had to go get copies of their IDs and send them into the bureaus, and it may take weeks to unfreeze their credit. Now things have changed. It's no longer cost money to freeze or unfreeze your credit. You can do that as a consumer as much as you want without getting charged. And it's much easier to freeze and unfreeze on yet, but and I'm gonna let you guys know that all three bureaus, Equifax, TransUnion, Experian, all three of them have mobile apps that you can download on your phone or your iPad, and you can freeze or unfreeze your credit real time. So theoretically, I can walk into a mortgage office with my credit frozen, go to my phone, unfreeze all three bureaus, wait 5 minutes, have the mortgage lender pull my credit, and then walk out and freeze all three bureaus again. That's much more convenient and time effective for both the consumer and the mortgage person. So if you're interested in getting that app, because I do know mortgage people who've gotten those apps to have them handy in the office when they, or when they run across this situation, or for your own personal use, you can go to the Google Play or the iTunes Store, and you can type in this search. You can say Equifax Credit Freeze mobile app, Experian Credit Freeze mobile app, TransUnion Credit Freeze mobile app. And you can download these apps and freeze and unfreeze your credit at will for free. Keep your credit on freeze, all things being equal nowadays. Now there's a 180-day waiting period for medical bills to be sent to collections. Before that wasn't in place. So now when you're fighting with your insurance company or going back and forth with the doctor's office or whoever you're dealing with, you have more time. They can't just flip it over the wall to collections in 30 days, which they would often do. And many times the consumer wouldn't even be contacted. By insurance. So we haven't quite reached the status of every medical bill being deleted upon payment, but we're headed in that direction. At some point in the future, every single time a consumer pays a medical bill, it will be deleted. And if you've heard for pay for delete, which we're going to talk about a little bit later, you know that most medical collection companies are already willing to delete the medical bill off the credit report upon payment because that's the way we're headed. And one of the other big changes is that debts that do not originate from a contractual agreement can no longer be reported to the credit report. You know, 10, 12 years ago, all we saw on, or 15, 20 years ago, all we saw on credit reports was major creditors, right? You had your mortgage, your 2 cars, your credit card, your gas card, maybe a lease you were in at one point, but that's really all you saw on credit reports. It gotten so bad in the last 8 or 10 years that you pull a credit report, you see all kinds of different utilities, which they can still report, but little nitpicky stuff. Here in Dallas, we saw parking tickets for the city of Dallas. Obviously, you don't have a contractual arrangement with the city of Dallas parking, so we'd see pet groomer bills and gym memberships and all kinds of stuff. So a lot of those little nitpicky stuff are being eliminated unless you have a contractual agreement with them. Before, anybody who had a beef with you could pretty much just go down to any collection company and they would take your word for it and slap it on your credit report. Now there has to be much more of a paper trail, and a legitimate contractual arrangement between the consumer and the person reporting the information. But you can find as much information about this if you want at this website, National Consumer Assistance Plan. There's a ton of great changes in there and things that should be affecting everybody. And, you know, there may be some tidbits and things in there that you guys can use for marketing purposes and other stuff. I'm going to talk about online disputing for a second because, you know, with the advent of all these credit monitoring sites and these fake credit scores, and we got to ask ourselves, why would the credit bureaus push out fake credit scores to consumers that are oftentimes 50, 60, 80 points higher than a lender-based score? And the answer is the credit bureaus really want to create a sense of complacency amongst their constituents or amongst the consumers, right? If you think your credit's better than it is, you're going to access it and try to use it more. And they have all kinds of advertising for credit and bad credit and medium credit and every other kind of credit on their website. So they're pushing consumers to products, number one. Number two, if they create that sense of complacency and consumers think their score is better than they are, they're probably a little less likely to hold the bureaus accountable or raise a stink or be upset or notice all of the have started pushing consumers to online disputing. You know, 15 years ago, as a mortgage person, if you pulled a credit report, you could be relatively sure, if you saw a bunch of disputes on a credit report, you could be relatively sure that that person was in a credit repair program. You know, they were working with me or somebody else in the credit repair industry who's disputing on their behalf. Well, the credit bureaus obviously don't like credit companies, and so what they've done is they've tried to steer the consumer to online disputing. You'll see it on Credit Karma, all the credit monitoring sites, and even directly on the bureau sites. It says, you know, see an error, dispute here. So a lot of people have fallen into this trap of online disputing. And so the reason the bureaus are pushing people to online disputing, because it creates a funnel for them to be able to handle those things in a different way. But the downside to it is this. When you online dispute, you waive a lot of your rights under the Fair Credit Reporting Act, and you only have one shot at it. And unless you have documentation and legal proof that it's an error, it's not coming off your credit report. And if it does come off your credit report, you didn't take it off for a legal reason. And you could be hurting your credit, because if you online dispute and say 8 collections are not yours, and you know that they're your collections, and they take them off, they can reinsert those collections 60 days, 90 days, 120 days later, and now your credit could be even worse, because now instead of a bunch of old collections on your credit report, you've got collections that have been reinserted with a new date. So you got to be really careful about online disputing. I wouldn't do it personally, and I wouldn't encourage any of your customers or anybody you know to online dispute. And if you hear of somebody talking about doing it because their friend did it and got a few things deleted, I would highly discourage them from doing it, because they could be doing more harm than good. It's not effective. You waive your rights under the Fair Credit Reporting Act, and if you are going to dispute something on your credit, you need to do it the right way, which is by written correspondence and certified mail. You always want to have a paper trail of everything you're doing with the bureaus. Common credit myths. These are pretty basic, but I'm going to fly through a couple of them. Obviously, we know that personal information cannot affect credit score, but a lot of consumers still think it can, whether it's how much money's in their bank account, how long they've been on their job, whether they even have a bank account or a debit card. I've had consumers say, hey, I don't have a debit card. Is that affecting my score? So personal information can never affect credit score. Paying a third-party debt collector, and listen, this is the 2 most common things we get from consumers. I paid that, how come it's still on my credit report? And I paid that, how come my credit score didn't go up? And we know, and you guys should know, that a paid collection and unpaid collection are graded the exact same amount of points. The only thing that drives score on a collection is the date it was opened. Not the report date, not the balance, nothing, just the date it was opened. That's why paying old collections can sometimes be harmful, because you could update the date of last activity. But all things being equal, if they're graded the exact same amount of points, we know that paying third-party debt collectors is never going to raise the score. And if a consumer says, hey, I paid that collection, why is it still on my credit report? The answer is this: because it happened. Right? You're not graded on balance, you're graded on the fact that it happens. And the reason there's this disconnect is because consumers view their credit reports as balance sheets. Somebody goes through a rough time in life, you know, they accumulate some collections, some charge-offs, a couple late payments. They're doing better. They got a great job. They want to go buy a house, apply for a mortgage. They pull their credit, and they think they need to go back and take care of all that bad stuff because they view their credit report as a balance sheet. And then they start throwing good money after bad money, right? We know that it's not a balance sheet. We know that it's a reflection of payment history and credit worthiness over 7 to 10 years. It's still there because it happened. They're recording the event, not the balance. Well, why doesn't it make my score go up? You don't get bonus points for paying it 4 or 5 years after it went to collections, right? So this de-incentivizes, or should de-incentivize the consumer from going back and paying third-party debt collection. Now, some people still want to do it because they have a moral and ethical responsibility in their heart to pay their debts, and that's fine, but we got to make consumers aware that paying collections is not a strategy to fix your credit or raise your score. If you do it, you're only doing it because you want to. A lot of consumers think that checking their credit will hurt their score. That's why Credit Karma and all these credit monitoring services are constantly running commercials saying, hey, did you know that checking your own credit doesn't hurt your score? Which is true. Checking your own credit never hurts your score. Anytime you self-initiate a credit check, it doesn't hurt your score. And we're going to talk about inquiries in a few minutes, but I'm going to give you guys the real deal on inquiries and what the real window is in the mortgage industry, because nobody really seems to know. Child support. This is interesting because why would I have child support on here? It's not really a myth so much as kind of a fun fact for you guys. I know you're all in Florida, but this is applicable to every state under the current scoring model that you guys are working on. Under the old mortgage formula, under the mortgage scoring model that you guys still work on, child support does not affect score. Meaning, if you have a client who has child support on their credit report or late payments on child support, it's not affecting their credit score. Well, how come you guys haven't really noticed that in the past? Well, the answer is people who don't pay their child support usually don't pay a bunch of other stuff. So they've already got bad credit from other things going on their credit report. But theoretically, you could have a borrower that has a mortgage, a couple cars, and credit cards that are paid on time, be 120 days late on their child support, and have a 760 credit score because the late payment, the child support itself does not affect score. It's a quirk in the old scoring model that you guys are on, but there's no 2-digit code to account for child support in the credit scoring formula that you guys use. The key to that, though, is if it's reported by the state. Now, in Texas, it's the OAG. I don't know what it's called in Florida, but the Office of the Attorney General, whoever administers child support in the state there, if it's an entry from them, either a collection or late payment, it is not affecting score. If they send it to a third-party debt collector, then it would show up as a collection and it would affect score. But the actual child support account itself and the relationship they have with the state will never affect score. We talked about opt-out earlier, right? It's a good idea for everybody to opt out. But there used to be, and I haven't heard this much in the last few years, but I've been doing this 15 years. And when I started, 15, even 10, 12 years ago, a lot of mortgage people were like, hey, I'm going to have my customer opt out because it raises the credit score. And that was right after opt-out came out and became a thing. But opting out does not raise your credit score. It's not in the scoring formula. It can't possibly affect credit score, but I still have people that are adamant that it can and does, but it can't and won't. But obviously there's a lot of benefits to opting out. It protects your borrower from getting unsolicited offers and being sold as trigger leads and things like that. But it does not affect credit score. Here's the dreaded pie chart, right? We've all seen this over the years. So 35% of your score is payment history, right? And then 30% is amounts owed, which is a misnomer. It's not really amounts owed, and I'll tell you why in a minute. And 15% length of credit history. If you add that up, that's about 80% of your score. People always ask, how do I get a good credit score? Pay your bills on time, keep your balances low, and have the same set of accounts open for 4, 5, 6, 7 years. That's how you get an 800 credit score. That's the formula. But 35% is payment history, 30% is, instead of amounts owed or balances, we'll call this utilization, right? And then 15% length of credit history. People that are chasing points and chasing miles and all these opening and closing accounts and opening retail accounts and getting $200 of Kohl's Bucks at Christmas and all that stuff, you can live with a decent credit score doing that, but you're never going to be A+. You're never going to be 750, 760, 780 and higher if you're closing and opening accounts all the time. And then new credit would be, how often are you applying for credit, the effective inquiries, things like that. And then types of credit used. To maximize your credit score, you need to have each box checked. So you have to have the mortgage box checked, the installment box checked, and the revolving box checked. All things being equal, if I had a mortgage and 3 credit cards, but no installment, I'm losing points. If you had a mortgage, a car, and 3 credit cards, your score would be a lot higher because you had the installment box checked. So having each box checked makes a difference. Well, some people don't like credit cards. Well, they're losing points because they have no revolving credit. Some people like to pay cash for cars. Well, they're losing points because they have no installment credit. Some people like to rent, so maybe they're not a homeowner, and they're losing points for not having a mortgage. So all things being equal, you always want to have each box checked, and you have to have an account active in the last 6 months in that category to be given credit for that type of credit on your credit report. So if you pay off a car and it's the only installment credit you have and you don't get any new installment credit for at least 6 months, then you're going to start losing points because you don't have that installment credit. A bar, hey, if you want to pay cash for your cars, that's fine. Go get a small installment loan at the bank, put it in savings, auto pay savings to the loan each month, and just build credit with your own assets and your own cash. Oh, I don't like credit cards. That's all right. Don't confuse debt with credit. People say all the time, why do I have to have debt to have good credit? You don't, but you do have to have credit to have good credit. That makes sense. So, hey, you got to play the game. So you need to have those accounts open. You just got to use them wisely, keep the balances low and pay them on time and whatnot. All right, so moving on from the pie chart, I'm going to talk about inquiries. The biggest question I get from mortgage people, like the toughest, not toughest for me, but the one thing they always wanted to know is, what's the real window for deduplication in the mortgage industry? Is it 14 days? Is it 30 days? Is it 45 days? Well, the answer is this. It's not 30 days. On one bureau, it's 14 days, and on the other 2 bureaus, it's 45 days. That's why nobody ever really knows, because it's both. On Experian, your window for mortgage pulls is 14 days. So a consumer can apply for as many mortgages within 14 days, and it counts as one pull. But outside of 14 days, it starts counting as multiple inquiries. On Equifax and TransUnion, because they're off version 2, still an old version, but they're 45 days. So on those 2 bureaus, the consumer has 45 days. So if a consumer asks you that question, I don't know if I would try to explain it to them. I might just say 45 days because 2 of the 3 bureaus are. But be aware that the window on Experian is only 2 weeks. We have a right as consumers to shop for the best rates and terms. As a consumer, you want to be able to check with a couple different mortgage partners or people you work with. As a consumer, you want to be able to shop for the best deal on an auto at multiple dealerships without getting penalized with multiple inquiries. This process is called deduplication. So we do have a right to 3 categories: mortgage, auto, and student loans. When you're applying for like services, you have a right to multiple inquiries, only counting as 1 during that window, because you have a right to get the best deal. So it works in mortgage and student loans because they're coded properly. Anytime you apply for mortgage, it's a mortgage pool. Anytime you apply for a student loan, it's a student loan pool. It does not work in auto because people go out, the dealer pulls it, that's coded as an auto pool. And unless they set up financing themselves, they're letting the dealer send it out to all their banks and credit unions and subprime lenders. And those are not coded as auto pulls. They're coded as general inquiries. So all of a sudden you have 30 inquiries on your credit, knocking your score down 2 or 3 points each. I've seen people's score drop 60, 80, 90 points just from car shopping over the weekend. So I wouldn't count on it for auto. And if you ever personally are going to purchase an auto, you need to make sure you tell the dealership that only they are allowed to pull your credit, nobody else, or set up financing through your bank and credit union. So soft inquiries do not affect FICO scores at all. And it's a soft inquiry for the following reasons. If you're checking your own credit, if it's an employment or insurance application, background check, security clearance, existing account review. So maybe you have a Capital One card you've had open for 4 years, and they're going to decide whether to offer you a limit increase. They can pull your credit, but it's a soft inquiry. Promotional inquiries or trigger leads. Of course, you can kill those by opting out. But most people don't know that collection companies can pull your credit. Did you know that collection companies can pull your credit? If you owe a collection company, they can pull your credit. If you have a charge off from Capital One 3 years ago, they can pull your credit. That's existing account review. You still have an account with them. So they're only allowed to pull your credit for what's considered permissible purposes, but those are permissible purposes to collect on a debt. So I see credit reports all the time with collection companies pulling credit. And when they see that you apply for a mortgage, or they see that, you're doing better, then all of a sudden those calls start ramping up and things magically change on your credit report. So that's why they're pulling that credit, is they want to see how they can kind of to stick it to you or force you to pay. We were talking about balances a while ago on the pie chart. I think I mentioned to you that let's don't call it balances or debts owed. It's not really about balances and debts owed. See, people confuse debt with credit. Can't really confuse debt with credit. You're not penalized for having debt on your credit report. There is no penalty for the balances on your credit report. If you can afford $1 million house and a $100,000 car, you're not penalized over a different borrower who has less of a mortgage and less of a car. That's installment credit. It's only expected to be paid on an installment schedule. So it's a set schedule, a set payment for a set amount of months. And the only thing that matters on installment credit is it paid on time? But revolving credit's different. Revolving credit is any account that you can control the balance up and down on, right? But again, it's not about the balances. And I'll give you guys an example. If Michelle has 3 credit cards of $1,000 and all 3 of them are maxed out, she's 100% utilized, but she has $3,000 in debt. If I have 3 $50,000 credit cards with 3 $10,000 balances, I have $30,000 in debt. I have 10 times the debt that Michelle has, but I'm only 20% utilized. So my score is a 740 and her score is a 660, right? So all things being equal, it's not about the balances or how much you owe. It's about what percentage are you utilizing. And that's called utilization ratio. And balances are a substantial score driver for the average consumer. I mean, they make a big difference. Just in the scenario I gave you, let's say we both are paying our bills on time. Neither one of us has ever made a late payment. But that utilization ratio is keeping her in the mid to upper 6s, and I'm in the mid 7s because I pay my credit cards off every month, or I keep them below 20%. Utilization ratio is the total of your balances versus the total of your limits, and it's scored across the aggregate. So it's all of them added together. The ideal utilization ratio is 1 to 19%. We know that you're always going to have the highest credit score when each individual card is between 1 to 19%, and when you're 1 to 19% across the aggregate, okay? If you want to have the highest credit score, do both. Keep your individuals below 20% and keep your aggregate below 20%. And there's different ways to affect utilization rate or ratio. A lot of times we may say, hey, I don't have the money to pay these balances down, but maybe their credit's good enough to get a limit increase, and that can uncover some balances. Maybe they can open a new line of credit, and uncover balances. So there's different ways to affect utilization ratio, but I would always strive to have the highest limits possible. That way, when you do use your accounts, it's not affecting your score. In the example I gave of 3 $50,000 credit cards, there's a myth. There's a myth in the older generation of mortgage and real estate that the higher your limits, the more of a credit risk you are. This is not true. It does not affect credit score having higher limits. It doesn't even really affect credit score having higher balances. It's strictly the utilization. So you should always strive to have the highest credit limits you can. It's not ever going to negatively affect your score. You've probably noticed trended data the last few years on your credit report, and a lot of people are very confused about trended data. What is trended data? Well, right now you can be maxed out on your credit cards for a year, 100% utilized, go apply for a mortgage, get the advice to pay your credit cards down below 20%, And now your score goes up 60, 70 points. So instead of a 630, you're now a 690 or 700, right? Because right now, the only thing that matters is what are your balances the day they pull your credit report. Well, trended data is going to change all of that. The reason we're moving towards trended data and the mortgage industry is moving towards trended data, and they're even going to start scoring us in newer versions of FICO, the ones that haven't come out yet. In newer versions of FICO, we're not going to be, right now, we're only graded on what are our balances right at this moment in time. In the future, we're not going to be graded on that. In the future, we're going to be graded on what was the average of our balances over the last 24 months. And why are they doing that? Why do they want that information? And why is the mortgage industry moving towards trended data? They're trying to figure out who is a revolver versus a transactor, right? Who's the revolver that was maxed out the entire year, paid them down to 20%, popped up 70 points, got into a mortgage, and then maxed them out again, and now they're back down to where they were, right? It's not mortgage fraud because it's within the rules right now, but it's not necessarily an accurate reflection of their creditworthiness either. A revolver is somebody who carries high balances all the time, makes the minimum payment, they're always over 80%, and are a habitual user of their credit cards. A transactor is somebody who has the credit cards, has great credit, keeps the balances below 20%, and most often, or a lot of times, just pays them off every month. That's the difference between a revolver and a transactor. And the reason the mortgage industry wants to know that, and the reason we're headed this direction is they've done a bunch of studies. If all things being equal, credit score, payment, everything being equal, only thing different being if you're a revolver or a transactor, everything being equal, the default rate on mortgages for revolvers is 7 times higher than the default rate for transactors. That's why they want to know that information, and that's why we're headed that direction. Have you guys heard of pay for delete? Pay for delete's become pretty popular in the last few years. What I will caution you guys against is do not instruct a customer to do a pay for delete unless you're 100% sure it's going to result in the desired outcome. And do not instruct customers to use pay for delete as a strategy to fix bad credit. We don't want to be instructing customers to do multiple pay for deletes. So really the only time a pay for delete should be used is in the instance of a single 1 or 2 collections that recently hit, and that's basically all the bad credit they have, and it's the big score driver, okay? You gotta be careful about pay for delete. Only about 30% of collection companies will do it. The consumer needs to have a deletion letter before they pay them a penny. A letter that says, we're gonna delete this account number from these 3 credit bureaus, because they will try to trick the consumer and say, we'll update it on your credit report. What they mean by update is show it as paid, which will not help the credit score, nor remove it from the credit report. So they have to have a deletion letter showing that it's going to be deleted off the credit bureaus. They'll have to pay it in full, and only about 30% of collection companies will do it, like I said, and that's mainly going to be your medical collection companies because they already know they're headed that direction anyway, and some smaller collection companies that deal with like cell phones and utilities and things like that. You're not going to do a pay for delete on a credit card charge off for $4,000 car repo. So it's only a tactic you want to use on recent collections. And you want to get that deletion letter because the collection companies get amnesia and you'll pay them and then they'll never take it off the credit report. You need to have that proof, that letter, for 2 reasons. One, two, they have it for proof later if they need to go get it removed from the credit bureaus. A goodwill deletion is the same strategy except for a late payment. Have you guys heard of a goodwill deletion? You know, it's actually a pretty effective technique. We use it in-house here and we encourage our customers to use it. But it's only applicable, again, like a pay for delete, kind of a single instance of collection. It's only applicable in the single instance of late payment. You're not going to get a goodwill deletion if you paid your Capital One card payment late 4 times last year and you're asking them to delete a late payment from last month. A goodwill deletion is only there for the single instance of late payment and usually a recent late payment in the last 6 months. You're not going to ask for a goodwill deletion on a late payment that happened 2 years ago. They're going to tell you to go take a hike. So for the single instance of a recent late payment, and they have to talk to somebody in the credit department. So when the consumer calls up the creditor and says, hey, I want to speak with somebody in the credit department, customer service won't do anything for them. but they need to call and speak with somebody in the credit department. They need to use that terminology, goodwill deletion, and they basically need to say, hey, look, you know what? I've been a great customer for 7 years. I've never made a late payment. This was an oversight on my part, you know, and I'm trying to purchase a house. Can you do me a favor and delete this off of my credit report? And it works a surprising amount of time. You're basically appealing to their good side and saying, hey, do me a favor. You know, this was a one-time thing. It's not going to happen again. And that's called a goodwill deletion, or goodwill deletion. And that applies to a recent late payment. But again, they got to speak with somebody in the credit department. And if they can obtain a deletion letter, that's great. But we're not going to push as hard for it in this instance because they're doing you a favor, right? So you kind of got to take their word for it. You're not paying them any money anyway, so you don't have anything to lose. You're just asking them to take it. Authorize your account. In 2008, the mortgage industry was supposed to move to FICO 8, and then it didn't happen. And in FICO 8 and FICO 9, there are some restrictions on authorized user. It needs to be somebody that lives at the same address or has the same last name. Now, currently, you guys are still in the old mortgage scoring formula from 20 years ago. So authorized user works as good now as it did anytime. So it's still very, very effective. But it must be used with a spouse, parent, or sibling. You don't want to get involved in piggybacking and sold trade lines. I know you guys are in Florida, and there's a lot of these companies out there. I get emails at least 4 or 5 times a week from companies in Florida trying to sell me trade lines. I got one this morning saying, hey, we got 3 $50,000 credit cards you can put any of your customers in to boost their scores. Well, I can't do that because I know it's mortgage fraud, right? There's nothing illegal about it, but it is mortgage fraud. And if you as the loan officer are aware that a client is buying trade lines or doing piggybacking, you can get in serious trouble for it. But these companies will sell these trade lines. And so you have a borrower that has a 550 credit score, and they get on 2 Amex cards of a retiree in Florida that's had these cards open for 30 years with a $40,000 limit, never paid late. Their score might go from 550 to 650. And then as soon as you get them into a mortgage, they're going to take them off next month, and they're going to be back down to a 540. That's pure and utter mortgage fraud. So you got to be very careful with that. But if it's a friend, if it's a spouse, parent, or sibling, and a family member, it's perfectly within the rules. It's perfectly ethical. It just can't be their only source of credit. So usually what I'll have them do is we want to make sure they have their own card, like a secured card, something like that. They have an installment piece of credit, but then we can supplement and boost the scores with authorized user. Most mortgage companies will accept authorized user. Some don't, but most will, as long as it's not their only source of credit. But authorized user refers to being added to a revolving account that's been open for more than 2 years, and you're getting the benefit of the history. That's the whole trick on authorized user. Just don't engage in the piggybacking. And these are kind of my rules of authorized user. You want it to be an account with at least 5 years. 2 years is okay, but it doesn't really extend the average age of accounts. The reason authorized user works is because you're taking that borrower that has 2 $1,000 cards that's been open for 1 year, and now you get them on a card that's been open 10 years, like 24 months, and that's what boosts the score. But it should be an account that's been open as long as possible with the highest limit possible, because you could also uncover balances that way. Utilization ratio on that card needs to be below 20% to get the best score, and it has to be somebody they trust that's never made a late payment or has no chance of making a late payment on that card. Because once they're on as an authorized user, any negative history is going to apply to them, and it's going to stay on there even if they take their name. There's got to be a level of trust there, but when it works, and nothing works like it. So building credit or thin files, I mean, oftentimes mortgage partners will say, hey, I have a borrower that doesn't have a score, or it says NA, file not scored due to insufficient credit. So we always start with 3. We want every customer we get that has damaged credit, or we're trying to help rebuild, or we're working with a mortgage partner, and that's kind of our baseline is 3 open accounts. If you want to get your credit in shape to buy a house, get a mortgage, and they're not there, we want to make sure they have at least 3 open accounts. And out of those 3 open accounts, we want to make sure they have at least 1 installment and 2 revolving. So secured cards are okay, but I would never do more than 2. I've heard a lot of mortgage people say, hey, get 3 or 4 secured cards. The law of diminishing returns kicks in, and it's not really worth it to get more than 2 cards. Get 2 cards. We're going to get the points we want for that, and what we need, or what we're going to be able to squeeze out of that. Make sure they get into an installment line, or you can do 1 secured card, 1 installment, and an authorized user, because authorized user will help generate a score quicker. So they could get a secured card, an installment piece of credit, and then that authorized user, they'll get the retro history for and pop a score quicker. But we want to target higher limit unsecured revolving lines of credit if for the authorized user. If they have to settle for a secured card, that's fine. Some people say, hey, you know, I pay cash for cars. I don't have any installment credit. This is where they can do a CD secured loan or CD secured savings account. But they need to have a good mix of credit, and that means having the installment box checked and the revolving box checked. And we always want to start with at least 3 trade lines as a base. Reporting a score. What time is it? Oh, we're heading right up on 2 o'clock, so I'm almost done, guys. So reporting a score. You must have had at least 1 open trade line in the last 6 months to report a score. And that trade line needs to have been reporting for 6 consecutive months. If you don't have that and you have a no score, it can take up to 6 months to report a score if one's not being reported. That being said, that's where sometimes authorized user can help us report a score quicker, and you can never report a score if you're deceased. And believe it or not, that happens all the time. Most mortgage people I know have at least had 1 client over the years that they pulled credit on that was reporting as deceased, and it's a big pain in the butt because they got to send all their IDs to the bureaus and prove that they're alive and things like that. But FICO score models look for length and depth of credit. So having the same set of accounts open for a long period of time and having all those boxes checked, all those different boxes checked are key. So we'll wrap up with student loans. It'll take about 2 minutes, but student loans is a big problem. It's the next big American problem. It could delay home ownership for a whole generation of people. 10 years ago, 12 years ago, total student loan debt was about $250 billion. 5 years ago, 6 years ago, total student loan debt was about $800 billion. In the last 5 years, that's doubled to $1.56 trillion, and it's snowballing. Nothing's happening right now to improve the situation. 44.7 million borrowers have student loan debt. That's a huge chunk of potential borrowers for you guys. Out of those 44.7, 5.1 are currently in default, meaning they haven't paid in over a year. They're in collections and or wage garnishment. An additional 10 million, so over 15 million, are either in default or late. So that's a third of all student loan holders, and they estimate in the next 5 years over half, over 50% of all student loan holders will either be in default or late. And a lot of these people are counting on forgiveness programs and income-based repayment programs and other programs that they've been told about or heard about that they may or may not be eligible for. Right now, for public service, only 423 people have ever obtained forgiveness in the U.S. for public service. Over almost 1 million are eligible, meaning they're working at a nonprofit hospital or a university or for the police force, but only 400 something have actually obtained forgiveness at this point. So, you know, a lot of people, they defer. Over 8-10 years, deferments run out, and then all that interest capitalizes, and they find themselves in a real bad position. The average amount of student loan debt is going up $2,000 per year per graduating class. So whatever it is this year, it'll be 2,000 more next year and 2,000 more the year after that. Right now, student loan debt has just eclipsed. I need to update this slide because I believe it has just eclipsed all credit card and auto loan debt in the U.S. combined. There's more student loan debt. And the federal government made $50 billion in profit last year on student loans, and that's with a third of all student loan holders in defaults or not making payments. See, the reason it's going to delay home ownership for a generation of people is because they've got to qualify for 2 homes. They got to qualify for the home that they're buying, but they already have a home on their credit report. It's called their student loans. The average repayment's 21 years. So they're paying an installment loan over 21, 25, some cases 30 years at an interest rate that's higher than a mortgage on an amount that could be 150, 200,000 or more in student loans. they've got to qualify for 2 homes. So it's a really tough situation. We have student loan solutions at Rising Point. If you ever have a borrower that you have to take 1% on FHA and they have over $60,000 in student loans, we can usually get that borrower a fully amortized payment at about 0.58 to 0.6%. So we can shave off roughly $400 per $1,000 of student loan debt you have to count towards DTI. And it's a fully amortized payment. By consolidating the loans and putting them on a different repayment schedule, we can get a fully amortized payment and get you a letter from the mortgage verification letter from the servicer. This takes about 4 to 6 weeks, but sometimes it's the only option for these people to get into a house. And it could be the difference between making a transaction happen or not, and or increasing the transaction amount that they qualify. Because really what they're trying to do with student loan debt is underwrite to the worst case scenario. We're just trying to make that worst case scenario a little more appealing. So anyway, we're Rising Point Solutions. We offer credit restoration and student loan solutions. Michelle Clark's on the phone with me. She's our regional manager for Florida. We've been in business since 2005 and have maintained an A rating with the Better Business Bureau. We're really relationship driven. We like to do a lot of educational webinars, happy hours, different things that we do. And listen, we'll help you guys on the close files. You guys, if you have a question about credit, call us. You can call Michelle, call me. We'll answer your question. You got a file, they're 12 points away from qualifying. You don't see anything on this credit analyzer. Let us look at it. We might see something you don't see. We'll help you get them across the finish line. And that's a non-revenue producing activity for us, but we'll do it because you're our partner. And our job is to help you close more loans. And I know if we do that, then you'll trust us with your clients that have a 540 and 30 collections that need 6 months of babysitting. So we'll help you on the close ones. We want the ones that you don't have time to manage or just need a little more formal help. But there's opportunities to do business together, whether it's somebody who's trying to qualify or it's a loan you close at 585 on FHA and they still have bad credit. You can throw them over to us. We might be able to get them fixed up enough to refi and do a second transaction with you 9, 12 months down the road. And they still need the credit help, because I've seen people get in FHA loans that couldn't get the electricity turned on because their credit was so bad. So, you know, if somebody needs help, feel free to refer them to us, whether there's a loan on the line or not. But we do want to help you guys close more loans. That's our #1 job. We have a lot of unique resources with our student loan programs. We have rent reporting. We have installment credit where they can save $25 a month and it reports to all 3 credit bureaus. We got a lot of cool stuff. And if you go to our website, risingpointsolutions.com, and click on the resources tab, you'll see a lot of those products. And they don't have to be a customer to use those. Our customers use them, but if you have clients that need help, they can go there and they can get a secured credit card or rent reporting or whatever they need free of charge. And it's just helpful links that we have on our website. So with that, I want to thank everybody for being on the phone today. I really enjoyed it. And I know that we probably did have some questions that I'm going to answer now. Michelle's going to go through the questions. And ooh, that last one by Christian, that's a good one. I'll address that one. But Michelle's going to ask the questions, and I'm going to answer them. That way you guys get all the questions answered. Feel free to stay on as long as you want. Michelle, what were the questions as we were going through the info?
Actually, when I was watching, Christian was the only one that asked the question. So while Carl answers this for him, you guys feel free to type any questions you have, and then we'll go through those. But what Christian asked was, would a sold collection trade line be a contractual agreement with the collection company? Yes.
Yes, 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 yes. Now, what kind of contractual agreement depends on, you know, on legal definitions and other stuff, but a collection company has the right to assume your contractual relationship and debt from the original creditor. So they're perfectly within their rights in A, collecting, B, reporting it to your credit report, and C, suing you. They can even sue you on behalf of the original creditor because they now own the debt. That being said, we don't see collection companies sue very often, but they obviously will put it on the credit reports once it's sold off, and they have the right to collect on that debt. Now, as far as the contractual relationship goes in an effort for us to get it off the credit report, a lot of times we are able to get them off the credit report because they can't provide us the documentation of that contractual relationship. So we are able to get that off quite a bit. And Christian also asked about Experian Boost, which, by the way, is, yeah, I mean, here's the thing about Experian Boost. like all the credit bureaus, they're just trying to make money and appear to be a consumer-driven organization. But Experian Boost only reports to one bureau, so it doesn't do any good for mortgage borrowers. I mean, I suppose if you had a borrower whose Experian was their mid-score and it was 10 points away from qualifying, then maybe it would be an option. But Experian Boost is not an option for people trying to fix their credit. It's not an option for people who want to have a thin credit file and not have that much credit because it only reports on one bureau. And it's not an option, it's not an option for most mortgage borrowers because we do need the mid-score. There could be some very specific circumstances that Experian Boost could be helpful, but it's very, very specific, and I just wouldn't. We don't mess with it, and we don't advise customers to do it. It's alternative credit too. That's another thing, And so if it's not a score issue and you just need that alternative credit on one bureau, I guess it could be helpful. But again, it's not a strategy for fixing credit or scores, and it's not something that's generally going to get somebody across the finish line to get a mortgage.
Okay, so we also have a question from Chris, who I met last week, who is with Suncoast Credit Union. He said, can you add an authorized user to an auto loan?
I don't believe so. And even if you did, it wouldn't help their credit because it's installment credit. And so when installment credit doesn't give you the score boost. Long term, it might help that person's credit after 4, 5, 6, 7, 8 on-time payments. But the reason authorized user works is because it gives you that immediate boost because it's revolving credit. It uncovers balances and gives you the retro revolving history. When you open installment credit, it temporarily lowers your score. Now, I guess if they backdated it to the beginning of the auto loan, it might help the scores a little bit. But I don't believe you can be added as an authorized user to an installment account at all. You would have to be added as refied on as a joint contractual responsibility, as financially responsible. I hope that answers the question.
Okay. I think it did. And then Mike with Raymond James Bank in St. Pete, he asked, once items fall off the report, do they still have any effect on scoring as part of the total history, or are they completely omitted at that point?
They're completely omitted. If it's not showing on the credit report, it's not factored into the scoring algorithms. So only information that actually shows on the body of the report can be factored into scoring. But that's a good question, and people have asked that of me in the past. But yeah, once it's gone, it's gone. Because if it was factored into the total history over time, then it would be very difficult for people to recover from bad things in their life, where it's a job loss, illness, divorce, whatever it is. We don't want to penalize people for life for having a rough time. And they know that 7 to 10 years is kind of a good reflection of somebody, how they, people make mistakes when they're younger, things like that. I had horrible credit in my 20s, guys. So hopefully, and now I have an 820 credit score. So, you have a chance always, no matter what the situation is, to get where you want to be and make it better. Any other questions?
No, I don't have any others here.
We really appreciate all of you guys being on the phone. I know Michelle will probably follow up with each one of you to get your feedback on the webinar or see if there's a way for us to work together. If we're not already, I know we're working with quite a few of you guys already on the phone, and we appreciate your business very much. But we want to bring some value add to you guys. We're going to be doing webinars every 90 to 120 days. And hopefully I'll come up with some new fresh content and go from credit 101 to credit 201 or whatever, and constantly be bringing you guys some value. But if you want a recorded copy of this webinar, I do believe we recorded it today. So just let Michelle know, and Michelle can have a recorded copy of the webinar sent to you, or a copy of the PowerPoint presentation, either one she can send to you upon request. Other than that, we appreciate your time and hope that you guys have a great rest of the day, and we look forward to working with all of you. Thanks, Michelle.
Thank you so much, Carl. Thank you, everybody, for joining us.
Thanks, Christian. Thanks, Chris. Thanks, Chris. Thanks, Frank. Claudette, Debbie, Elizabeth, Mike, Patrick, Ryan, Vicki. We appreciate all of you guys being on the phone today. Have a great day.